Good morning, everyone, and welcome to our exciting webinar covering the tax highlights from the autumn budget. My name is Dawn McDougall, and I'm a tax partner in our Edinburgh office, and I will be your chair for today's session. The autumn budget was one of the most eagerly anticipated budgets in living memory. The positioning ahead of this budget was all about tough political choices, with a black hole of 22 billion and public services in need of vital support. In the final analysis, tax rises totalling 40 billion were announced, but there were a few surprises which will impact individuals and businesses alike. Today, we are going to break down the key points in relation to employment taxes, VAT, capital gains tax, and inheritance tax. We will assess their implications and help you understand how these changes might affect your financial planning and tax strategies in the year ahead. There were also significant changes announced to the non-domiciled tax regime, which we do not plan to cover today as we're still awaiting publication of the detailed legislation. Today, we're joined by a panel of tax experts from our tax team here at Henderson Logie, who will walk us through the updates in detail and give us updates and insights on how to prepare for these changes. If anyone has any questions, please can you put these into the chat box at the bottom of the screen, and we will cover them at the end of the session. So thank you for joining us, and let's dive into the budget tax highlights. And I will now pass you on to Richie McPhee, who is a manager in our employment tax team.
Thanks for that, Dawn. Welcome everyone to this update. And as Dawn said, I'm going to talk about the employment taxes changes that were announced in the Chancellor's budget last month. So the main change that was announced is obviously in respect of employers' national insurance. These changes are due to come in from the 6th of April 2025, so essentially the next tax year. The Chancellor announced that the rate of employer NIC is going to increase from 13.8% up to 15%, so a rise of 1.2%. And the secondary threshold, which is the threshold at which employers start to pay employer NIC, is going to come down from the current 9,100 per year down to 5,000. That threshold is due to remain in place until the 6th of April 2028. And from that point, the secondary threshold will increase by the Consumer Price Index, or the CPI. Obviously, as part of the manifesto, the rate of employee NIC hasn't changed, so the Chancellor has kept to that promise. As well as the employer NIC rates going up, the Chancellor did announce some good news in that the employment allowance is also going up. So currently, eligible businesses are able to claim up to £5,000. From the 6th of April 2025, that is being more than doubled to £10,500. The Chancellor also announced that the £100,000 NIC limit will no longer apply, but as things stand, businesses that were previously ineligible, excluding those that were ineligible due to the NIC limit, will remain ineligible. If we look at what that means for an employer, so this example gives an idea of the additional cost, excluding income taxes, for an employer employing an individual. So if we had someone who has a salary of, say, £10,000, currently, due to the NIC threshold, the amount at which the employer would pay employer NIC is £900. So £900 at 13.8% would be £124.20 that the employer would have to pay to HMRC. From the 6th of April 2025, that same employee who has a salary of £10,000, the threshold is obviously reduced down to £5,000. So the amount at which is taxable for employer class 1 NIC would be 5,000. It's also taxed at the higher 15% rate. So the employer NIC liability would be £750. So as you can see at the bottom of the slide, the increase in NIC payable by the employer is £625. Now, some of that may be negated by the employer allowance, which is obviously increased to 10,500. But as kind of pointed out on there, if you do have a number of employees, that could be a significant cost to the business. In terms of employee benefits, the other main change, or not so much change, but confirmation, is that the government is going ahead with their proposed changes of all benefits being, or almost all benefits being reported via payroll rather than P11Ds from the 6th of April 2026. The employer class 1A NIC is also increasing to 15%, but that comes in from April 2025. So similar to basically salary. As things stand, the only benefits that cannot be payrolled are accommodation and loans to employees. However, the government have announced that they're looking into whether or not they can be payrolled going forward. The reason being that the accommodation benefits and loans are based on the official rate of interest, and normally that's not known until the end of a tax year, which is why those two benefits still have to go on P11Ds. One of the big changes that wasn't announced in the Chancellor's speech, but was actually in the budget release notes, is that from April 2025, all double cab pickups will be treated as cars. So previously, in most cases, double cab pickups were treated as vans unless that double cab pickup had a payload of less than 1 ton. But going forward, from April 2025, they're all going to be treated as cars. For an employer, what that means is that in terms of capital allowances, if they purchase the vehicle, they cannot claim annual investment allowance. Instead, they'll just get the reduced special rate allowance, which is a lot lower, obviously. For the employee, the benefit that they're taxed on will be based on the emissions of the vehicle and also the list price, which I would imagine for a double cab pickup would be quite high. And so they're going from a position where they're taxed on a benefit of roughly, say, £4,000 to, unknown. It really depends on the list price and the CO2. There are transitional rules for the double cab pickups. So if you previously owned or leased the vehicle prior to the 6th of April 2025, you will continue to be taxed under the van benefit rules until the earlier of when the vehicle is disposed of or sold or the lease has come to an end, or the 6th of April 2029. There's no changes to the rules in terms of PAYE settlement agreements, but that is one of the areas in which the employee is going to be paying more tax if they are using double cab pickups. That essentially covers the points on the national insurance and employment taxes. The government also announced that there was no changes to the rates and bandings for UK taxpayers. Obviously, that doesn't cover Scottish because the Scottish budget hasn't been announced yet, and so we'll wait and see what happens there. But that covers the employment taxes and NIC. I'll now hand over to my colleague, Alan Davis, who is the VAT partner at Henderson Lobby.
Thanks, Richie. So in terms of VAT, this was a fairly, what I would describe as a straightforward budget. There was one main current change and significant change, and that was around VAT on independent schools. And the biggest point to start with is that there was some hope or desire from the sector to have at least a delay, and the budget confirmed that there will be no delay. It will be implemented according to the plan that has already been put in place and be effective from January the 1st of 2025. And it's a straightforward change, but it's a fairly historic change. In the over 40 years I've advised in VAT, there hasn't been such a significant change from what was previously exempt to taxable treatment. And I guess that's partly due to the I'm going to say benefit or the impact of Brexit and the removal of the constraint of being required to follow EU law. Now that we're out, we can do whatever we like, and this is a prime example of a government taking that opportunity. But it's impacting a sector that's never had VAT really to deal with before. VAT has been a cost in terms of their expenditure. They couldn't recover it, and historically budgets were set on that basis, and this is a significant change to the sector. The change means that VAT at the standard rate will apply to all inclusive education and boarding fees that apply to sessions of education after the 1st of January 25. There is a kind of carve out for separately charged fees, so things like transport and catering. If there is a separate charge for these, what they call closely related supplies, they will remain exempt. But HMRC will be looking at those quite closely to see that there isn't a shift of value from the taxable school fees into those exempt supplies, and to avoid some VAT and value shift in that way. Essentially, there is some anti-avoidance legislation that's brought through with it, but long and short is that any educational sessions from the 1st of January onwards will be subject to VAT unless it was paid for in cash or a receipt for before the 29th of July. And even then, anything before the 29th of July will be subject to HMRC review because they'll want to see that it was done correctly. And these significant prepayments were sufficient to beat the deadline, but it requires a clarity over what's being paid for and for what period. HMRC estimate that whilst the standard rate goes on top at 20%, the impact on fees might be a 10 to 11% increase because there is VAT recovery on related expenditure. I have to say the examples I'm looking at for clients, the rate might be nearer 14 or 15%. So I'm not quite sure how HMRC do the sums, but that will no doubt wash through in time. So in practice for schools that are impacted, registration is now available. It became available on the 30th of October. And the biggest change for them is obviously charging VAT on the fees themselves, but then being able to recover VAT on expenditure that directly relates to that taxable activity, the supplies of exempt education. And that can even reach back up to 10 years for capital items. So that's items over £250,000 upon which VAT has been incurred. So lots of schools have fixed assets that they've done work on in the last 10 years that they're now reaching back to, looking through fixed asset registers and trying to identify that they can then look back on. And then the final point on that, really, it's kind of unconnected to the schools themselves, but I've been asked a number of times about, can we just not direct the school fees to my business and we'll just recover the VAT through my business? My advice on that is that it's not a business expense necessarily. There might be an argument that the future manager and director of your company needs educating and needs developing through school. I think that argument will not be well heard by HMRC and it's unlikely to be approved. But I know some people were exploring that option. I think it's a challenge, put it that way, to try and get VAT recovery in that way. We are doing lots of work for schools in this sector. There's a lot of detail below the kind of headlines, and partial exemption then kicks in. Many schools have retained exempt activities, things like the extras that they're charging, and also welfare supplies, breakfast clubs, and nurseries. So they'll be into partial exemption and will need support with partial exemption calculations, and we're obviously working hand in glove with clients on that. So that's the kind of key current VAT change that is really impacting at one particular sector at the moment, expecting to generate about 1.6 to 1.8 billion in the first few years, in the context of the 40 billion that the overall budget raised. Not the biggest number, but obviously having a significant impact on the sector. So that's VAT. I'm now going to pass over to my colleague Edward, who is going to cover capital gains tax.
Yeah, thanks, Alan. Good morning, everyone. Just a quick reminder, we do have a question and answer box in the bottom of your screen that if you have any questions, please feel free to pop them in there. So first of all, as expected, there was a immediate change to the rates of CGT. So these went up from 10 and 20% for basic and higher rate taxpayers to 18 and 24%. So I think even though it was expected, there was rumours of this being a lot higher. There was talk of this being equalised with income tax, so upwards of 40% tax rate. So I think those people who did a lot of planning before the budget, who were expecting this, will be slightly relieved that they capitalised on those lower rates. And those who were waiting for the budget will also be slightly relieved that it hasn't gone as far as we expected it to go. You'll see the new rates are in line with the residential property rates. So these were slightly higher rates that were in place for sales of residential property that wasn't your main residence, so second homes and let properties. So perhaps an area that Labour will look to increase in the future. Among the headline changes, there were also some big changes to business asset disposal relief. So business asset disposal relief is essentially a beneficial rate on the first £1 million of gains made on a trading business that you own. Now, these rates weren't implemented immediately, so these kick in from the 25-26 tax year, going up to 14%, and then the year after up to 18%. Similarly, investors' relief. So this relief is for unincorporated businesses in which you own shares, which you are not an employee of. The rates have gone up in line with business asset disposal relief, but the big change here is the reduction of the lifetime limit. So it was £10 million and it's reduced down to 1 million, similar to what we saw with business asset disposal relief or entrepreneurs relief a few years ago. So how do these changes look? So here I have an example of the capital gains tax on the sale of a £2 million business. So before Rachel Reeves did her budget, if you had a £2 million gain, 1 million would be taxable at the lower rate of 10%, and the further million would be taxable at the higher rate of 20%. So immediately post 30th of October, you'll see there's a initial 40 grand hit in tax, and that is the uplift in the higher rate of CGT. Going forward to 25-26, you have another 40 grand hit, and that is when the BADR rate starts increasing. And then similarly in 26-27, it's another 40 grand hit. So if you are in the middle of selling your business and you want to push it through before the end of the tax year, it's worth about 40 grand. But obviously you have to analyze that from a commercial standpoint, whether it will be worth more in a few months' time and if that's necessary. Usually, if someone's selling a business, we would offer advice regarding transferring a portion to their spouse, so they could capitalize on their separate £1 million allowance. There's various conditions with this. They have to own 5%, they have to work in the business, but most importantly, they have to own the shares for at least 2 years. So if you're selling your business and you have to wait at least 2 years, that puts you into the 26-27 rates. So in this scenario, that would be slightly beneficial, but higher amounts, it might not necessarily be so. But obviously, you'll have to consider the commercial considerations. So what else has changed? So the annual exempt amount, this was the exempt amount of gains you could make in any tax year before you paid any capital gains tax. So this used to be 12,100. Last year it dropped down to 6,000, and now it's only £3,000. There's no changes to sort of reduce this in the future, but I think what we'll see is a lot more people being brought into the capital gains tax net, as obviously if you have a small shareholding and you make modest gains, all of a sudden, where you wouldn't previously, you're being asked to pay capital gains tax. There was a change to the carried interest rules, so this only affects fund managers, but the rate used to be 28%, and from the 6th of April next year, this is being increased to 32%, and then the year following, it will be taxed as income. We don't necessarily know exactly what this means, whether it will be taxed as other income or employment income, and it will be applicable to national insurance contributions. But I'm sure the government will have more details to follow. There were a number of reliefs that Rachel Reeves didn't touch that we thought she might. One of the biggest ones, of course, is holdover relief. So this is a relief when you gift a business asset to an individual or any asset into a trust. It essentially allows you to hold over the gain. So the giftee receives the asset with your original base cost. And the benefit of this is that you can start gifting assets away and not pay any immediate capital gains tax. It's a very useful tool in succession planning for businesses or general inheritance tax planning. Principal private residence relief. So this relief is obviously when you sell your main home. If you've lived there for the duration of ownership, then there's no tax on this. I think there would have been a slight uproar if Labour had axed that. One area we did think they might look at is the CGT uplift on death. So this is when someone passes away and the beneficiary receives their assets. They inherit those assets with the base cost being the market value at the date of death. So if it's a husband and wife and the husband dies, the wife then receives all those assets with the market value base cost, meaning you do have the opportunity to give those assets to the next generation while not paying any capital gains tax. Reinvestment relief is still around. So if you make a gain when you sell an asset and you reinvest those proceeds into qualifying EIS or social enterprise schemes, you can essentially freeze the gain from that original asset until the EIS shares are sold. This used to be quite a useful tool because you could use it to use your annual exemption allowance every year. But now it's down to £3,000. It's not so beneficial. But the thing to consider is if you're freezing a gain now at a rate that you know is 24%, and you sell your EIS shares in 5 or 10 years, and the capital gains tax rate has gone up to 40%, obviously you're going to be worse off. So it's something to consider from a planning point. And finally, rollover relief is still around. So this is when you sell a business asset and you reinvest those proceeds into buying another business asset. It essentially rolls over the gain, so it reduces the base cost of the new asset, so you don't have any immediate charge to CGT. So yeah, there were a few changes that were expected and a few I don't think we were quite expecting, but certainly a lot of planning to be done around this. And with that, I'll pass you on to my colleague Darren, who's going to be discussing the changes to inheritance tax.
Thank you, Ed. As was expected in the budget, there was a lot of speculation before that inheritance tax would be looked at. Excuse me, the inheritance tax would be looked at by the Chancellor, and sure enough, it's safe to say there was some significant changes that were undertaken. If we first look at the nil rate bands, for those who don't know, everyone has an allowance of £325,000, which is your annual allowance before any IHT is charged. There's also the resident nil rate band. So if you have a main residence that you leave to direct descendants, such as your children, there's a further relief available up to £175,000. Now, there was some speculation about whether that resident nil rate band would be altered or scrapped, but in the end, the amounts are remaining the same. However, they have now been frozen for a further 2 years until the 6th of April 2030. What this does in effect, though, is due to the fiscal drag with house prices increasing, assets increasing, it means more estates might be liable to inheritance tax in the future. And then when we look at a couple of changes shortly, that might have even more effect. It's worth noting, though, that these allowances can be transferred. So if there's a husband and wife or civil partners, upon the first death, if everything gets left to the other spouse or civil partner, they can be transferred still free of inheritance tax under the spousal exemption, and that hasn't changed, which means that the nil rate band and the resident nil rate band can also be transferred across to both the surviving spouse. Moving on to pensions, now this was one area that was one of the first big changes announced in the budget for inheritance tax. From the 6th of April 2027, pensions will now be included in an estate for an individual upon death, which was a change from what was previously. Generally, pension pots are exempt from inheritance tax, which now means, combined with the freezing of the nil rate band, means that, it's potential that these pension pots will now be subject either some or all inheritance tax rates at 40%. It's also worth noting that when they die, if they're over the age of 75, when the beneficiaries inherit that pension pot and draw down the funds and take the income from it, they'll also be subject to income tax. Now, in Scotland, if someone's an additional rate at say 40, the 48% tax rate as we're in now, is effectively a double tax charge at that point when that's incurred. So when you combine the inheritance tax at 40% and potentially the additional rate tax at 48%, it gives an effective tax rate of up to 69% when they take that pension or when that's inherited. So, a significant tax charge and a significant change to what was previous. The other big significant change announced in the budget was the new rules on agricultural and business property relief. So from the 6th of April 2026, whereas previously qualifying agricultural property or business property, so that's generally farmed, trading companies, if you met the conditions associated with APR and BPR, you would get 100% relief for that upon death. That's now changed, so there'll now only be £1 million of APR or BPR eligible assets to get the 100% relief. It's worth noting within that, though, that's combined. So if there's an estate that has a combination of APR and BPR, it's just £1 million across both types of assets. And it has been mentioned that this will be prorated between the APR assets and the BPR assets. We're still waiting on full legislation, but it doesn't seem like you can choose which type of assets to associate that relief with. For the assets remaining that are above £1 million, there'll be 50% relief applied to that, and then they will be taxed at 40% to give an effective tax rate of 20% on that property. Unlike the nil rate band and the resident nil rate band, there will be no transfer of these excess allowances to the surviving spouse or civil partner upon the first death. So, but each individual will have their own £1 million allowance, which might make some sort of planning around assets and transferring them between spouses maybe more important than previously has been. For individuals, though, that also have investments on the alternative investment market or AIM shares, previously they were classed, well, in general, most of them were classed as business property assets, and you could get the 100% relief from inheritance tax from those as well. That's going to change too, and they will only be 50% relief. But note that there's no £1 million allowance on this, so it's just 50% relief in every circumstance, given again effective tax rate of 20%. So how will this apply in practice? Well, if we take an example here, we've got an individual, so this is on there was a surviving spouse or civil partner, this is on the second death. So in this instance, they have a house, cash, other assets, listed shares, they've got 400,000 of AIM shares, and a pension pot of £1 million. And if we see under the current rules that the £1 million pension is exempt from inheritance tax, there's the full transferable nil rate band and the resident nil rate band. and then 100% relief on the AIM shares. So essentially in this example, the whole estate there's no taxable estate, and then there's no inheritance tax due. Once the full rules come into effect from the 6th of April 2027, we'll now see that the pension pot now falls into the inheritance tax estate, and that gives a total estate of 2.4 million. So there's now two effects to that. Is the BPR has halved at the 50% relief to only give relief of 200,000. But again, and we mentioned this earlier, but when for the resident nil rate band, if the estate's over £2 million, that relief gets tapered. So we'll see in this example that there's only relief for the resident nil rate band of 150,000 rather than 350,000, which means now that the estate that was previously not subject to tax at all, 1.4 million, will be subject to inheritance tax at 40%, at 560,000. So what does that mean on the impact in the planning? So it means the transfer of value between spouses is very important. You could still use the spousal exemption. As I say, the new BPR and APR doesn't allow for the transferring. There's only the £1 million, but there is options still within that to, it might be worthwhile transferring some BPR or APR assets to the spouse if you've not already done so. Another impact we've not really talked about too much today is utilising trusts. Trusts are one way of transferring assets that they can be used against for passing over to children. It's been announced that for trusts set up before the 30th of October, they will get a £1 million allowance for the BPR and APR assets. But trusts set up after the 30th of October, there's going to be a sort of change where that £1 million allowance will be apportioned by the number of trusts that are set up. We don't have full legislation and detail on that. There's going to be, I think there's a consultation at the start of next year. So we'll need to wait and see on what that impact is. But trusts might be a useful way of being able to transfer some assets out of the estate. There's lifetime gifting, which might become more important than ever to utilise the 7-year clock, so you can transfer assets as a potentially exempt transfer, and after 7 years, it could be exempt from your estate. And then a further change of planning around what is spent and gifted. So whereas previously the pensions was one of an effective planning tool, it might not be the same planning effect going forward, and might need to look at the assets that you've got in the round to decide what's best to gift or what's best to use in your lifetime to maintain your living. So I think it's pertinent to note that while there's still planning that can be done, it's maybe different if some of the advice that's you've had previously might now need to be looked at and revisited, just to ensure that everything is up to date and how it aligns in with the new rules. And that's a summary of the inheritance tax changes. And then I'll pass you back over to Dawn just to finish off and summarise.
Thanks very much, Darren. Please put any questions into the chat. So to sum up briefly, there have been some significant increases in employers' national insurance contributions, and despite the new employment allowances for smaller businesses, many business owners fear that they are going to have to pass these costs on to customers or to restrict future recruitment. The fact that VAT will be charged on private school fees from January 2025 was not a surprise. And this, as you can imagine, is having a major impact on the sector, with many private schools passing the VAT costs on to parents. The capital gains tax changes were not huge, as many expected them to be higher and perhaps to be more aligned with income tax rates. Many of us expected business asset disposal relief, i.e. the 10% tax rate, to disappear immediately. However, this is being phased out over a period of 2 years. So there is a period to April 2025 when businesses can still take advantage of the 10% tax rate. The changes to business property relief and agricultural relief together with the inclusion of pension savings into a death estate, were a bit of a surprise. And these changes will have an impact on many businesses and individuals, and will mean that planning done previously will have to be revisited. The last time there were such significant changes to the inheritance tax regime were in 2006, and I do think the changes announced last week will be felt much more widely. So we do have one question, which I think, Darren, you have already answered. A pensioner age 75 or more, will the residual pension pot be subject to IHT and also the recipient's taxed as income tax, possibly at 80%, Darren? I think you said it was going to be a bit lower.
Yeah,
still
when we've had a look at the
prohibitive.
figures and calculate it out, yeah, it's one to note that, for those that pass away over 75, yeah, there's effectively that double tax charge at 40%, and then an additional rate in Scotland at 48. It works out to be an effective tax rate of 69%. I think if you're based in the rest of the UK, it works out around about 67%. But yeah, I think we've worked out like a sort of £2 million pot is around about 574,000 for an additional rate taxpayer when you actually work out the numbers. So yeah, it's a significant tax effect.
And Alan, will schools just add 20% to fees, or will it be less, given they're able to reclaim some of the VAT on costs?
Yeah, that's a good question, and it's one that the schools have been grappling with in terms of budgeting and sharing fee upgrades for next year. Some have not added anything and just taken it from reserves until things settle down. Some have gone for a 20% increase because that's what they have to add on, and any benefit of the input tax is then taken back into reserves, and they can use that in the future. And some have just gone in the middle and said, well, based on our budgets, we think it's, as HMRC say, it's probably 11 or 12%. Many of the ones I've looked at are nearer 15%, but they just try and break even back to where they were before VAT was imposed, but allowing for that, as you say, that VAT recovery.
And will this impact nursery schools as well?
It shouldn't. Nursery schools are and continue to be exempt. So I suppose the issue there is that most of them are, or many of them are attached to private schools, so that brings them into partial exemption and creates a compliance cost and compliance pain for them. Yeah,
so lots of complexity for these schools.
Mm-hmm.
And how long generally will it take to get VAT registered?
It literally is a piece of string question.
Mm-hmm.
HMRC say they've added extra resource to try and get that through. I haven't practically had any experience of doing it yet, but pre the school part, the VAT registration process was probably about 4 weeks, but you can get some overnight as well. It's kind of a strange, hard to predict process, unfortunately.
Great, thank you very much. Richie, have you any idea how many businesses in the UK the NIC rise is likely to impact?
Yeah, so the Chancellor basically thought that of all the of all the businesses in the UK, she thought there would be around 1 million of them would feel little to no impact, or they would actually be better off because of the rise of the employer allowance. Obviously, until the actual numbers are actually realised, it's hard to know exactly how many, but that was certainly the Chancellor's initial response to how many businesses were likely to be affected. Yeah, as I say, it's hard to know until we actually get to that point where the rises are felt by employers.
Yeah, I suppose you just have to run the figures to work it.
Yeah, absolutely. Yeah.
And you mentioned the Scottish rates. Is it likely that Scotland is going to follow?
Yeah,
suit?
I mean, it's hard to know.
What do you think?
It's hard to know because obviously we do have so many different tax rates compared to the rest of the UK, and just because the UK government don't kind of change anything doesn't mean to say we won't. From a practical standpoint, I think it's likely that they probably won't do anything in terms of changing the bandings or even the actual the rates. But until, well, I guess it'll be likely in December that they'll announce their actual budget, because it's not actually been announced yet. It's a wait and see approach.
Yeah.
But my initial gut reaction is no, that the Scottish government won't do anything with the bandings, but it's very much a wait and see.
Yeah, let's just wait and see what happens, and also just quite interested in salary sacrifice arrangements. Do you have any idea how these are going to be impacted by the changes?
Yeah, so at the moment there's no impact. It was expected that the government would either apply national insurance, employer national insurance on any amounts sacrificed, or at the very least they would come up with a hybrid rate, and the numbers banded were about 6 or 8% NIC on amounts of salaries sacrificed. The government didn't actually go ahead with that, which is good for obviously people who are sacrificing part of their exchanging, maybe a better word, exchanging part of their salary for either increased pension contributions or for company vehicles with low emissions. So as things stand, there's no change to the rules around salary sacrifice. So there's still a potential saving there for the employee and the employer to sacrifice / exchange part of their salary into.
That's really useful. So definitely still worth
yeah, absolutely. Yeah.
Thanks very much. Ed, I was wondering, will the reduction in the capital gains tax annual exemption, do you think that's going to force people into the self-assessment net?
Yes, it probably will. I mean, the annual exemption used to be 12,100, so there was a lot more people who just stayed within that net and didn't have to do tax returns. And I didn't mention this, but rolled onto that is the reduction in the dividend allowance to £500. So even people with sort of modest portfolios might have to come into self-assessment to report those dividends and report any gains, anything that's held outside of an ISA, effectively.
Great. And also another question, if you're looking to utilise your business asset disposal relief allowance potentially as a gift, so you can actually pass shares, etc., on to family members, is it better to do this before the end of the tax year? Or does it not really matter?
Well, it essentially does. If you're looking to use your BADR allowance, and instead of claiming rollover relief, by using your BADR allowance, you're realizing the gain, so that whoever you're passing the asset on to doesn't have higher gains in the future. So I think in my slide I mentioned there would be that increase in the tax rate over the next 2 years, and those changes haven't taken place immediately. So if you are gifting it to one of your children, it is just more beneficial to do that immediately and pay a lower rate of tax. So yes, and there's no commercial considerations. So absolutely.
Yeah, so just really to think about that in advance. Darren, is it now more important to ensure that business property relief and agricultural property relief, property that's eligible for these reliefs, is transferred potentially between spouses or down to other family members to utilise the £1 million allowance? Presumably they each have their own allowance.
So it's definitely something that probably should be looked at. I mean, unlike the nil rate band, that allowance can't be transferred between spouses. So you might have a scenario if there's a husband and wife, and it's the husband's business for argument's sake, and it's a business related property. If he was to pass away, yes, everything could be transferred to the spouse, but that £1 million allowance is effectively potentially lost at that point, whereas transferring it over between the spouses, at least then, levels off and they each have £1 million each at that point. Or utilising other things like potentially trusts to then take £1 million out of the estate as well at that point. So it's definitely something to potentially consider and look at. It's not maybe just as straightforward as everything goes to the other spouse, or if you're passing it further down the line to children, etc.
Yeah, so just important to think about it. And I
Yeah.
suppose you've a trust if potentially you don't want to pass these assets down to family members for protection
Yes, exactly.
of family assets. And why would making use of the lifetime gifting earlier help succession planning to maximise these reliefs?
Yes, so looking at the 7-year clock. So if you pass assets over as a potentially exempt transfer, once 7 years has passed, it's exempt from inheritance tax. So there's maybe an opportunity to look at some of the business property or agricultural property assets, passing them over earlier. Now again, you've got to look at your own circumstances if you need the income or other considerations why you maybe wouldn't do that. But if it was something that was possible, doing it earlier allows, if you're younger, you're likely to be more healthier, things like that. So passing it over earlier takes that 7 years. And then, although we've not had all the legislation come out about it, but in likelihood, your £1 million allowance would then reset again after that 7 years. And you've got an opportunity to then basically do the same thing again at that point. And that doesn't mean to say it's to a spouse, that could be to children, it could be to somebody else. There's certainly opportunities there.
Yeah.
And just in general planning.
Yeah, no, that's what I was going to say. We've got a sort of 17-month window to, really think about it, because obviously we have done a lot of planning for clients. Just really important to think about any planning that's been done in the past. Great. Well, in the absence of any, sorry, we've got one more question. Should you consider taking your 25% tax-free element from your pension pot now? Darren, what are your thoughts on that?
I'm probably going to heavy caveat that says it's probably based on your own circumstances at the time. Not as a financial advisor, I can't comment on whether it's advisable for you not to do that. I mean, certainly if you take the 25% lump sum, strictly speaking, I suppose if it's in cash in your hand and it's still in your estate as a pension pot, overall it'll still be in your estate at that point. You can maybe use it or not, but certainly, I think that's probably more an individual circumstance of whether you need that or not from there. But I mean, it's maybe a consideration if you feel that it's useful for yourself. But as I say, I'm not a financial advisor, so I can't provide that bit.
Yeah, and I suppose just take advice from your go and see your financial advisor. Really important to do that. There's one more question which we'll just try and squeeze in. Sorry, Darren, it's for you again. Is there a concern about pets of APR, BPR eligible property being treated as a gift with reservation of benefit, where the gifting party stays on in the business, lives in the farmhouse, etc.? I would say yes, there probably is.
Yeah, I think I would agree with you there, Dawn. I think no, it's under the terms of it, if you gift something that you still retain the benefit of, either as a gift for reservation of benefit or potentially a pre-owned asset charge if it's a cash consideration, yeah, it's more unlikely that could be a concern. So yeah, we probably need to look at that. And just see how you would structure any gift to ensure that it didn't fall from that, or you took mitigating circumstances. It might be they could pay the rent to cover that and it wouldn't be a gift with reservation. But yeah, I think it more depends on the detail of what you're looking to do.
Yeah, absolutely, and just highlights the importance to look into these things and take advice. Okay, great. Thanks very much to all our speakers, and thank you to everyone for listening to our webinar. I hope that you found it useful. We will be hosting further webinars on key topics, so please look out for this. We will be sending the slide packs out to you afterwards, so if you've got any questions, please do get in touch. And thanks again for listening, and I hope you all have a lovely rest of the day.